Welcome to the Market Rent Weekly Brief, your go-to source for the latest insights and updates in the real estate market. Each week, we'll bring you the most important news and trends to help you stay informed and make smart decisions. Let's dive into this week's episode.
All right, so Los Angeles. I mean, this is a city that it's like always on the global radar, right?
Oh, absolutely.
Just look at the Residents' Best World Cities report. They've got it at number 14.
Yeah.
And it makes sense if you think about it. I mean, it's the planet city of stories.
Mm-hmm.
Plus, coming up, we've got this whole decade of sport thing happening,
Right.
with the World Cup in 26 and then the Olympics and Paralympics right after that in 28.
Huge events.
And that's actually a pretty big deal. It makes L.A. the first U.S. city to host the games 3 times.
Yeah. I mean, it just keeps raising the profile, doesn't it?
It does. And I think it explains why L.A. ranks so high in lovability and culture, like number 12 and 10.
It all ties together, that global appeal, the cultural scene. It's all part of what makes LA so attractive, especially for investors.
Exactly. And that's actually what we're going to be digging into today. We're talking about the multifamily property sector in L.A.
Right, because even though LA's got this iconic status, when you look at the numbers, there are some shifts happening in terms of investment.
Yeah, and it's kind of surprising because, L.A. County's share of U.S. apartment investment has actually gone down. Back in the 2010s, it was at 5.4%.
Yeah, I remember seeing those figures.
But now, this decade, it's down to 3.7%. And get this, in 2024, new apartment construction in L.A. hit a record low.
Oh, wow. Really?
Yeah, only 1.1% of the national total. And to put that into perspective, the 10-year average is 2.5%.
That's a pretty significant drop. What's really interesting is that this trend seems to be specific to LA. When you look at Orange County and San Diego, they're pretty stable in terms of apartment investment.
So that begs the question, what's going on in LA that's making it different? What's driving this change, and what does it mean for, anyone who's involved in this market?
Right. That's the big question, isn't it? And I think a lot of it boils down to the regulatory environment. It's a major factor influencing investor sentiment right now.
Okay, so let's unpack that a little. What specific regulations are we talking about here?
Well, let's start with the COVID-era eviction ban. That was a big one. I mean, think about it. It was in place for 3 years.
Wow, it's a long time.
It is. And as a result, we saw some of the lowest rent collection rates in the entire country. That kind of extended period without consistent rental income, it really had a big impact on investors, even beyond those immediate financial losses.
It makes sense. If you're not getting that steady income stream, it makes the whole investment a lot riskier.
Exactly. And then you've got the 5.5% transfer tax on apartment sales. That's another significant factor. It directly cuts into an investor's potential returns when they decide to sell. So it really raises the bar for making a profit, and it might even encourage investors to hold onto properties for longer periods to try and offset that initial transaction cost.
So you've got this double whammy of lower rental income and then a big chunk of your potential profit taken away when you sell.
Yeah, and that's not all. More recently, we've got this county-wide eviction ban related to wildfire impacts. This new ordinance allows renters to self-certify financial hardship because of wildfire-related events.
I see. So that adds another layer of complexity for landlords.
Exactly. And it's understandable why some landlords might be concerned about this. I mean, it does open up the possibility of extended vacancies based on these, broadly defined criteria. It just adds another level of uncertainty.
So it sounds like when you take all of these regulatory changes together, it paints a pretty clear picture of why investors might be hesitant about LA County right now, especially when you compare to places like Orange County or San Diego, where the policies are more consistent and predictable.
Yeah, exactly. I mean, stability is key, right? And when you have all these moving pieces in the regulatory environment, it creates a riskier and more complex situation for investors.
But even with all that said, it's not like the entire LA market is a no-go zone, right? I mean, when we zoom in on downtown LA, we see a pretty different story in terms of residential development.
That's a great point. Downtown LA, it's been remarkably resilient in its residential sector. Think about it. You've got around 55,000 existing residential units in DTLA.
Yeah.
And then another 27,000 in the pipeline just waiting to be developed.
Wow, that's a lot of housing units.
It is. And a significant portion of those existing units, about 38,000 of them, are market rate rentals and condos.
Which means they're not subject to rent control or other restrictions, so their prices are set by supply and demand.
Exactly. And what's really encouraging is that the demand in DTLA is strong. We looked at the 2023 DTLA residential report, and it shows occupancy rates are typically at or above 90%.
90%, that's really high.
It is. It means that people really want to live in downtown LA. And it's not just one type of building either. The mix of residential properties is pretty diverse. You've got about 43% mid-rise buildings, 33% high-rise towers, and then a significant portion, 24%, are adaptive reuse projects.
Adaptive reuse, that's where they take those older buildings and convert them into residential spaces, right?
Yeah, exactly. And it's been a really successful strategy in DTLA. Back in 1999, they passed the Adaptive Reuse Ordinance, which made it a lot easier to convert these often underutilized commercial buildings into apartments or condos.
So that was a big turning point for downtown then.
It was. It really kickstarted that initial wave of residential growth in DTLA. To give you an idea, between 1999 and 2008, adaptive reuse projects accounted for a whopping 87% of all new residential inventory in downtown.
Wow. So they took these historic office buildings, a lot of them from the 1920s, and turned them into these unique living spaces.
Yeah, and they managed to preserve a lot of that original character and architectural detail while adding modern amenities. It's a really smart way to revitalize those older structures and create much-needed housing.
And it sounds like this whole adaptive reuse approach is still a viable option in downtown LA, right?
It is. The new Downtown Community Plan, they call it DTLA 2040, actually broadens the scope for adaptive reuse even further.
Really? How so?
Well, now any building that's over 25 years old is eligible for conversion. So that opens up a lot more possibilities for residential development in the area.
So even with the current regulatory challenges we talked about earlier, DTLA still has a lot of potential for growth in its residential sector.
Yeah, absolutely. It's got this built-in momentum and a solid plan for the future. But, for investors who are looking at the LA multifamily market right now, it's crucial to be strategic and informed.
Right. So what are some of the key things investors should be considering in this environment?
Well, first off, the scale and time horizon of the investment are critical. Large institutional investors, they might be a bit more cautious because of the regulatory uncertainties. But for smaller investors, those who have a longer-term outlook and a really good understanding of the local market, there might still be some really great opportunities out there, especially in the diverse neighborhoods of DTLA.
So maybe those smaller, more nimble investors are better suited to navigating these complexities. What else should investors be keeping in mind?
Another crucial thing is a thorough regulatory risk assessment. You really have to do your due diligence. Look at all the current tenant protection regulations, understand what's coming down the pipeline, and think about how all of that could impact your operations. That includes everything from eviction moratoriums to potential rent control measures.
So it's about knowing the rules of the game, both now and in the future.
Precisely. And another thing, neighborhood selectivity is super important. The LA market is not homogeneous. It varies a lot from one area to another. Investors really need to pinpoint those specific neighborhoods that offer the best risk-adjusted returns. So that means looking at local demand drivers, what kind of development is already happening, things like that.
So a one-size-fits-all approach to LA just won't cut it.
No, not at all. And then, it's also smart to think about product type diversification. Different types of properties come with different risk profiles. For instance, those adaptive reuse projects in DTLA, they might offer some unique advantages because they've got that inherent appeal and there's already a streamlined process for getting them approved.
So the very type of property you invest in can impact its stability. Makes sense. Anything else investors should be thinking about?
The last thing, but definitely not least, is exit strategy planning. With that 5.5% transfer tax on apartment sales, it's essential to factor that into your calculations. Think about how that and other factors might affect your ability to sell the property down the line.
All right, so those are some key considerations for anyone looking at the LA multifamily market. Now, we've been talking a lot about downtown, but what about other areas of LA, like South LA, for example? How does that compare?
So South LA, it offers a very different investment profile compared to DTLA. There are a few key things that make it stand out. First, affordability. Land and property values in South LA are generally lower than in downtown, which could translate into higher returns for investors. And that could help offset some of the perceived regulatory risks.
So the lower initial investment could be a big draw.
Exactly. And then you've got these major institutional anchors in South LA, like USC. They're making substantial investments in the area, which creates a sense of stability even when there's uncertainty in the broader market.
Yeah, those big institutions can have a ripple effect on the local economy and the housing market.
They do. And then you've got all the transportation improvements in South LA, especially the expansion of the metro rail lines. That's making it much easier to get around, which could help insulate these areas from some of the market pressures affecting other parts of the city.
So it's like Downtown has its advantages in terms of that established demand and the success of adaptive reuse, but South LA offers a different set of potential benefits, like affordability, the influence of those big institutions, and the improving infrastructure.
Yeah, that's a great way to put it. It's really a tale of two cities within one larger market.
And I think when you step back and look at the big picture, it's clear that the LA investment landscape in 2025 is a lot more complex than it was 10, even 5 years ago. I mean, LA still has a lot going for it, don't get me wrong. Its global status, its culture, all the investment in infrastructure, those things all point to long-term value.
Hmm.
But the regulatory environment has added a whole new layer of complexity that investors have to really understand and factor in.
Absolutely. You can't just jump in blindly anymore. Success in this market is going to depend on having that granular neighborhood-specific knowledge, understanding how to navigate the regulations, which can be really complicated, and having that long-term vision. You need to be able to adapt as things change.
And that's really highlighted by the different strategies we're seeing from institutional investors versus smaller investors. They're approaching things in very different ways.
Right. Different players, different game plans. And then you've got downtown LA, which seems to be a bit more resilient than other parts of the city because of all the development that's already happening there and that DTLA 2040 plan.
It's like they've got a roadmap for the future.
Yeah, exactly. But no matter where you're investing in LA, whether it's downtown, South LA, or anywhere else, it's crucial to have a solid grasp of the regulatory landscape and how it could impact your investment, both in terms of operations and your eventual exit strategy.
So the bottom line is, LA is still a global city with a lot of potential, but the investment game has changed. It's more nuanced, more data-driven, and success is going to come down to managing risk, having realistic expectations, and being really smart about how you approach this market.
Exactly. Los Angeles in 2025, it's a market full of opportunities, but it's also full of challenges. You've got to be prepared to navigate both.
Well said. So to all of our listeners out there, the multifamily developers, the owners, the property managers, what are you doing to adapt to this evolving landscape? What innovative strategies are you exploring to make the most of the long-term value that the LA market has to offer?
It's a question worth pondering. There's a lot at stake, but also a lot of potential for those who can get it right.
Absolutely.
It's going to be fascinating to see how this all unfolds.
It is. Thanks for joining us for this deep dive into the LA multifamily market. It's a complex and dynamic landscape, and we hope this conversation has provided you with some valuable insights to help you make informed decisions.
I hope so too. Thanks for having me. It's been a great conversation.
Always a pleasure. Until next time.
That's it for this week's edition of the Market Rent Weekly Brief. To access more insights and resources, visit marketrent.us. Thank you for listening. To learn more about how Clarendon can help you achieve your real estate goals, please visit us online. We appreciate your trust in us as your go-to source for market intelligence. Our goal is to equip you with the critical insights and data necessary to make informed decisions. Until next time, stay informed and stay ahead.